Good evening to all to today's special lecture program for undergraduate students on finance and its allied areas, organized by Kolkata Bidhannagar Society for Academic Advancement, West Bengal, India, and coordinated by Azure Academic Services, West Bengal, India. Today's topic of discussion is Introduction of Financial Management and its Basic Concepts. Our resource person is Kajal Tiwari ma'am. She is visiting faculty of Department of Commerce, Maharani Kasiswari College, Kolkata, India. Welcome ma'am.
Thank you.
Thank you ma'am. Please take over the session.
Okay. Thank you. So, hello everyone. Welcome to KBSS, that is Kolkata Bidhannagar Society for Academic and Advancement. So today I'm going to cover the chapter. This is the finance. The subject is financial management. And under this, I am going to cover here today your basics. Plus, we will see little bit of introduction regarding this. So let's see. So your dream needs some action. You have to do action for that. Success doesn't come from what you do occasionally. It's come what you do regularly. So with this note, let's start. So see, we are going to do in this basic things. Okay. So what is finance? So finance is basically what? In simple word, we know finance means money. So this money, how you are going to use this money? How you are going to collect some money, and how you are going to use some money as an investment, and how much you are going to get some return. So that is the finance. So finance is the study of money, investment, and the financial resources. See how money is raised, how money is invested, and how risk and return are managed, and how financial decisions are made. So these are the things we are going to do under this. So for example, you see, if you invest 10,000 in stock market, or suppose in a bond, mutual fund, anywhere, you are dealing with a finance. So basically, three types of finance. You can see personal finance, corporate finance, and the public finance. Personal finance means it's individual money. It's your individual money. And what is the second? It's your corporate finance. Corporate finance, it's basically a company money, or you can say an institution or in any organization, those who are going to manage that. And the public finance, it means a government revenue and the government expenditure. Like government revenue and is tax, and government is going to construct something for the public. So that is your public finance. So the chapter name is what? Financial management, basics of financial management. We have heard about the finance. What is finance? That is your money. Now see, financial management. So here what we are going to do? Here we are going to manage the money. How we are going to manage the money? See, for any organization, we need some money, we need some capital. With the capital, we are going to start that business. Or after that, we are going to think on the investment. And then we will get some return, either the profit or loss. So if either the profit is happening, then we have to distribute with to the shareholders or the those who are involved with the company, or otherwise we have to, if we are or sometimes we retain something. That is your retained earning. That is a flowing back of money to the organization. So see, financial management is concerned with the procurement, allocation, and control of financial resources of an enterprise in a manner that ensure the achievement of its objective. And what are the objectives? See, that is the planning of fund. Planning of fund means you need some money. We need some money. We are going to plan that from where we are going to get money, from where we are going to invest that, and from where we are going to return that. We have to think about the risk also. So raising of fund, allocation of the fund, and the control of fund. That is your financial management, the basic thing. Okay. Now see, suppose it's you. And you thought, let's start a business. You thought, I need my own company. I want to start my business. So as a student, you want to start a business of a chocolate factory, or love to eat chocolate, so you want to start a business. So for that, what you need? So you are thinking to start a business. For that, you need what? You need some capital. Or here we heard that is finance, that is the money. So you are thinking, I need this money. So that is basically, see, financial management. So basically, this involves the three decisions. Number one is your financing decision. Second is your investment. पैसा तो आ गया. Now where you want to put that so that you will get the good amount of return. So you have to see the risk also. And then in the last, you will get what? That is your dividend distribution. So that is dividend distribution. Yes, that is dividend distribution or distribution of your money. So financing. Financing is what? You are going to collect some money for investing into your business. So basically, you are going to collect some money, and for that collection of money, need some observation. You want to observe from where I'm going to collect so that my cost of capital, this cost of capital will be less, because your main motive is what? I need some money. For that money, you are going to invest into your business, and for something you are getting, something you are taking from somewhere, and you have to return that money, because ye kya hai? It's your what? You are collecting that money. Return to dena padega. You have to pay the return back. So you are going to think in such a way so that your cost will be your KO, that is your weighted cost will be the less. So see, there's a different way from where you can collect the money. Like first, basically I'm writing equity share. Second way is your preference share. Let's write the full little bit. Then you can collect with a debenture and some bond. And the fourth number, there's so many financing like a venture capital, angel financing. You can finance from there also. That we have collected. So these are the sources. These are the sources of capital from where you are going to collect that money. So for equity share, you will get a cost. You have to pay some cost. You are collecting. See, equity share is what? We are getting money from the public. Preference share, we are getting money from the public. Debenture is a debt. Sometimes we get money from the public, and here you can see the bank also. We can collect some money from the bank. Hey, bank, I need some loan. For what purpose? I want to invest in my business. That's why I need loan. So in all these activity, you have to collect some money, and then what you have to do? You have to pay something, na? ये क्या है? तुमको कुछ मिला? Then you have to return back. So that is your cost. So that is the cost of capital. You are getting a capital, and for that you have to pay the cost. So that is your cost of capital. So for equity share, you have to pay. That's called KE. That is your cost of equity. And the preference share is what? KP. That is cost of preference share. And the debenture, you have to pay KD. Yes, KD. And the return and angel financing is something different. So KE, KP, and KD. Something missing? Oh, okay. KRE. That is your retained earning also. But that is a different concept. You will see this in the dividend decision. And you will see this one, because this is what I will tell you this later, a little bit. Okay, let me erase this. So see, these are the sources. Now suppose my one student name is Neetu. Neetu started a business, chocolate business. So need some capital. So these are the sources from where the Neetu is going to collect capital, and instead of that, he has to pay return also. So the Neetu is thinking that, oh, I have to pay back also. So where the cost will be less, that will be the beneficial toward the company and to Neetu also. So cost, wo portion she has to see, which is giving a KO is minimum. That is, your cost will be minimum. So this is the way you are going to finance money, and with that financing activity, now for that you have to consider more things like mm, like like the cost of capital. So now you have seen these sources. Now Nitu is thinking where the cost of capital will be less. Okay, we have to return back also. So Nitu is thinking where the cost of capital will be less. So the equity share is that where the cost will be highest. Why highest? See, in the equity share, you have to pay the interest, you have to pay some percentage of return, and preference share, you have to pay a fixed dividend. And on the debenture, you have to pay interest, whatever the rate is given. So you have to pay this way. So see, the cost of equity, the cost of equity is highest. Why highest? Because when you are starting a business, so the equity is what? Owner fund. So the owner fund is very valuable. Why? Because तुम अपने कलीजे का टुकड़ा दे रहे हो किसको? Public को. So you are sharing your owner equity. So that is very costly toward the public. So ये काफी costly होता है. And the second is preference share. That's good. You have to pay some fixed amount of interest. That's fine. And on the other hand, you have seen what? KD. That is your debenture. Also, in this case of debenture or in the case of bank from where you are going to get the loan, so in that case, what you get, that is the cheapest source. That is the cheapest source of finance. Why the cheapest source of finance? See, why the cheapest source of finance? Let's see. Because here you get the tax benefit. How? Basically, what we have seen, cells. क्या होता है? सेल होता है ना? Sales minus क्या कहते हैं? Variable cost. Then we will get what? Contribution. Then we have to pay interest. Then what we will get? Profit. That is your EBIT. Earning before interest and tax. Then you have to pay what? Earning before interest and tax. Then you have to pay what? Interest. Then what become? Earning before tax. Then you have to pay tax. Then तुम्हारा क्या आ गया? Earning available for you have to pay here you pay the preference share also. So earning available for equity share holders. No, you cannot write. I think you have to you have to pay also preference share. Just I'm writing the earning available. Okay, that's your earning. So see, here you see. Suppose you have taken the debenture. So in case of debenture, you have to pay interest, and here you have to pay some interest. That is your fixed. And debenture is one thing. There is a suppose a company is earning and the company is paying. So in case of debenture, you have to pay the fixed amount of interest. So in that case, that is what? That is a charge on profit. Charge means something you have to pay fixed. On the other hand, you have seen like equity share and the preference share. They are not the charge on profit. Why they are not charged on the profit? Because it's not a fixed amount, or they are not charged on profit because it's not compulsory to give them. Preference is compulsory, but in case of equity share, it's not compulsory because company have to think. If the company is facing loss, then they have to think and they have to adjust within the company, because equity share is what? The owner of the capital. So they have to think. But when the company is going to distribute a profit, they have to think first about the liabilities. They have to pay some liabilities. Why? Because the liabilities coming from the outsiders. They have to pay. And then अंदर के लोग आएंगे ना? Yes. So in case this is what? This is the interest, that is a charge on profit. It's a compulsory to pay. So when you are, suppose you are going to get the fixed cost. Sorry. So when you are paying interest, so in suppose your EBIT is 1 lakh. So when you are timing it, when you are paying when you are getting 1 lakh earning. So in that case, suppose you are paying interest of 20,000. Now you got 80,000. Now you have to pay tax. Suppose you have a pay tax of 10%. So in such a case, what you will see, with the help of interest, your earning is going to reduce if you are not paying this earning, if you are not giving this interest to the public. Then at that time, your earning before tax will be 1 lakh. If this amount I'm going to reduce, then your EBT will be what? 1 lakh? Yes. So you have to pay tax of 10%. That is your 10,000. So it is doing what? It is reducing your tax payment. So that's why people generally go for the debenture. They generally go for the interest method so that they get a cheapest source of finance where the KD will be the cheapest, where the interest will be the cheapest. So that's why the Neetu is going to choose what? Debenture method, because it's the cheapest source, but that she is getting the tax benefit. So that is your financing. Okay. And one thing you have to say here, see, see, you got different sources of cost of capital. You have seen cost of capital. See, in the balance sheet, what you see? You see equity, you see preference, you see some current liabilities. So basically, preference, or you can say here debt also. So basically, this portion is called capital structure. And in the capital structure, you see how much you are going to keep equity and debt. So क्या पढ़ा हो बचपन में? What is the ratio of equity and debt? 2:1. So ये क्या है? एक balancing approach है कि 2:1 होना चाहिए. But basically, this is the general approach. But we have to think more on this, and the whole, and this is the whole portion, like your capital structure plus your current liabilities or short term debt. You can say current liabilities or your short term something debt, like that. So current liabilities also you can consider. This is the whole is what your finance financial structure. That is your capital structure. So this one is the whole finance. So basically, when you see the different cost of capital like KO, the cost of equity, KP, that is cost of preference share, cost of retained earning, I will tell you later on this, and cost of debenture. So with that, we will get the overall cost. This is what single cost, but we have to do aggregate. On the aggregate, you will get a weighted average cost. And the weighted average cost is your Q. So on this is what? This is your cost of whole. weighted average cost. This is one cost, and on this cost, that's very important cost. You want to reduce this cost. You want to reduce this cost so that your value of the farm, so that your value of farm is good. So that your value of the farm is going to high. You want to reduce this cost or you want to increase this cost. So this is the basically your financing activity. Money to aa gaya tumhara capital, and you thought, oh, from where I have to select the money so that my cost will be less. And after that, what you're going to do? After that, you're going to invest your money. Kahan laga hai paisa? So let's see. That is also important concept. That is what? These are what? These are the different financial decisions. So I have to draw. I am going to take some extra page here. See, so pala activity done. What is the first activity is? So basically, first see this. So we are doing what? We are managing finance. So we are managing finance with three activities. First is financing, then investing, and then dividend distribution. Okay. So this is your financial decision. You are making a decision. Yes. Mhm. This is your financial decision. You are taking a decision. Okay. So with that, you are going to get the value of farm. इससे क्या मिलेगा तुमको? Value of farm. What is value of farm? That is market share of your value in the market में कितना value है तुम्हारा farm का. So value of farm किन decision से मिलता है तुम्हारा? ये function है किसका? Basic function of what? Function of financing activity. You are investing. I'm just writing short, okay? And then dividend decision. So with this, you are going to get the value of your farm. And main motive of new to organization and institution is what? The value of farm is going to be high and high and high. And how you are going to get this value of farm high? When your cost of capital will be low and low and low. And you got what is cost of capital? We already learned about that. So this is the normal thing. And now see some more concept. Easy peasy. समझ में आ रहा है? आता होगा तुम्हें. See. So you got to know the financial activity, value of the farm is going to high, and then your cost will be less. You will going to get where the cost will be less. So you feel good. And cheapest is your debt, and the highest is equity because the owners are very valuable. So now see, अब आते हैं किस पर? अब now move to the second activity. That is your investing activity. Investing. So तुम यहाँ collect कर चुके हो finance. You have collected the finance, and after collecting finance, you are going to invest into your business. अब ये तुम्हारा business था. किसका business था? We have created what business? We are doing the business of chocolate. Yum chocolate. So चलो chocolate का business करने के लिए चाहिए हम लोगों को क्या? We need something. We need some asset. We have to invest into some asset. We need big machine for making chocolate, and we need some material also. So basically, अब तुम invest करने वाले हो. Where? So ये investment भी कितने type का होता है? एक होता है short term के लिए, एक होता है long term के लिए. So here you see, one is long term and another one is short term. Short term is what? Your working capital. Short term is your working capital. जहाँ पर क्या करने वाले हो तुम? डे टू डे एक्टिविटी को मैनेज करने वाले. यू आर गोइंग टू मैनेज द डे टू डे एक्टिविटी. So you need what? You need a cash. You need a liquidity. For that, you have to. In this chapter, you are going to see. This is also one chapter. Okay. So in the financial decision, you will see so many chapters like capital structure, cost of capital, budgeting, working capital. So in the working capital, you are going to see what? See, क्या देखने वाले हो तुम यहाँ पर? अच्छा, सबसे पहले तो हम लोग डेटा मैनेजमेंट करेंगे. And then what you are going to manage? More cash management करेंगे. And then inventory, stock management भी करेंगे यहाँ पर. So ये क्या है? तुम्हारा day to day activity चलता रहता है हमेशा. So data management में आप करोगे, stock manage करोगे, cash में आता है तुम्हारा Baumol का model आ जाता है. Different इसके भी भी बहुत सारे models हैं. You are going to read that later. So in the long term financing, and that is your capital budgeting. Capital budgeting. So ये है capital budgeting. So you are going to, after collecting capital, अब उस capital का क्या करोगे? Budget करोगे. You are going to invest the capital budgeting. And capital budgeting is a long term process and it's irreversible. Irreversible. एक बार पैसा गया तो लौट कर नहीं आने वाला. आएगा obviously. You are going to invest it. So investment जब जा रहा है तो obviously you are going to get some return also. There is a risk factors also involved, but it's investment. This investment is irreversible. Why? See, these are the irreversible, and you will see different type of method here, like a NPV method. You are going to see different type of method. With the help of this method, you will see the how much, which, where I am going to invest. This one, or this one. Different type of method. You will see where I'm going to invest so that I am getting a same amount of income or more income, not less than, not less. See how you will see NPV, IRR, profit index, profit, something profit related is there. So different method you are going to see on this. With the help of this method, you will see what. अब यहाँ से क्या किए थे? फाइनेंस लेकर आए थे. फाइनेंस कैसे लेके आए थे? केओ से. कैपिटल, दैट इज फाइनेंसिंग इज व्हाट. कैपिटल लेकर आए, तुमको रिटर्न करना, तो दैट इज द कॉस्ट ऑफ कैपिटल. ओके, सो दैट इज योर फाइनेंस. नाउ दिस फाइनेंस, सपोज you have to pay cost of capital 10%, and now you have invested in capital budgeting. Suppose I have chosen IRR method. I have applied, I have invested into something, and after that I'm going to return, that is investment return. So how much return you are going to get into a project? You have applied into different project. अब उससे रिटर्न कितने आने वाला है? How much is going to your return? This is the method. IRR is a method from where you will get how much return you are getting. Suppose इस वाले project से मिलता है तुम्हें 10%, and from this project, this second वाला यहाँ लिख ही देता है 1, 2 and 3. So from this project you are going to get 8% return, and from the third one you are going to get 20%. It's too high, but fine. So this is your cost, and with this cost you are going to compare with this return. This is what your return. Return, why? Because you invested this in, I can write here the project, so you feel good. Project. So different project is there, and you are going to invest, and after investing you will see how much return I'm getting. So you will see my cost is what, 10%, and you will see my return is 10%. Okay, 10%, 10% equals to 10%, equal. You feel satisfactory. Okay, and थोड़ा सा smile करो. Satisfactory. Okay, and now your second you will see 10% is 8%. Oh my god, it's too less. Yes or no? So you will not choose this project where you are getting an IRR 8% IRR. No, we are not going with this. So you rejected this. Now see the third one. You will see the 20%. So you are very happy with this project, and you are going to invest in this project. So this is your investing method. So here you see how you invested the money, and after that you are going to see the different method, that is your dividend decision. So with that, move to the not next page, but we are going to take more later space. So we have done what? अभी तक क्या किया हम लोग? So we did what? we have taken the money, and after that we invested into a project, and now what? Now we are going to get return. Yes, and with this return, that is your, you got my EBIT, then you have to pay interest, then you have you paid the tax, then you got what? Earning available for equity share. So that is the your own capital, that is your own return you got. Now with this earning available for equity share, or not earning available for only equity share, for preference share also, for the debenture also. So I'm just writing EBIT, okay? Just writing a profit. So you find it's fine. So with that, you are going to see. Oh, so you are going to see two method here. What? एक तो क्या हो रहा है तुम्हारा प्रॉफिट, प्रॉफिट, या तो तुम्हारा लॉस हो सकता है, ठीक है, और या तो इक्वल अमाउंट पे रह सकता है, लाइक कुछ नहीं हुआ, नो प्रॉफिट नो लॉस. तो सी, अगर तुम्हारा प्रॉफिट होता है, so you have to see two decision here you have to take. One is what? Distribution of what? Dividend. So you are going dividend distribution, and then this is your dividend distribution method, and with that you are going to do one more activity, that is your, you can say, retain earning. अब यहाँ तुम डिविडेंड को डिस्ट्रीब्यूट करोगे एंड देन कुछ प्रॉफिट क्या कर लोगे, फ्लो बैक कर लोगे इनटू द ओन बिजनेस. फ्लो बैक मतलब खुद के लिए रख लोगे फॉर योर ग्रोथ. फर्दर भी तो इन्वेस्टमेंट करना है ना, सो दैट्स व्हाई यू विल कीप फॉर द ग्रोथ पर्पस. सो दैट इज योर फ्लोइंग बैक ऑफ प्रॉफिट, दैट इज योर KRE, that is cost of retained earning. Okay, here you will get the cost of retained earning. And dividend distribution is what? Here you are going to distribute your dividend. And here is also different type of method, you will see different method here also, but we are not going to do these methods. So this is the normal process of your financing decision. So you have seen the three method. First you have collected the some investment, you have collected finance, that is a financing decision, and with that you have invested into the business, and then distribution of dividend or retaining some earning for the further growth or future. So this is the simple thing, you got the overall idea. And when you are distributing this dividend, the farm followed, basically there is a two method, you will see traditional method, where the farm focus basically on profit maximization. And on the other hand, there is one approach, that is wealth maximization. So see, what is this? So what is the objective of your organization? What is the objective of your business? Profit maximization or wealth maximization? In the traditional method, we follow the profit maximization. Here we follow not the time value of money. Here we follow the discounted method, I think. In this approach, we follow the time value of money. It's an overall idea. It's in the detail we will learn about the time. What is time value of money? In the short, I will tell you what is time value of money. Time value of money is what? The value of your money, not at single point of time, at different variation point of time. Now the value of money is something different. In the future, it will be going to be different. How? Because suppose, for example, you are buying a coconut, not coconut, dab pani. Now you are going to get with 100 rupees 2 coconut water, one. And suppose in 2027, with 100 rupees, you are going to get only 1 coconut water. So, ek pani chala gaya tumhara, but with same cost you are going to get. So that is the time value of money. The value of money is depreciated because of price changing, because of change in the price. So that is with the this has happened because of inflation, and that is the time value of money. Or there is something else also. The value of money is what? Now with 100 rupees, you can, if you don't think on this small, if you think you have a 10,000 rupees and if you invest somewhere, then you will get some return. So that is what? The value of your money, you will get the return. So that is some factor which is affecting the interest factor, the approaches from where you are going to get the return. That is the time value of money. So see, so this factor is we're not considering the time value of money. So basically, they focused on the profit, not for the wealth of the shareholder. And on this approach, they focus on the wealth of the shareholder. And the wealth of the shareholder is what? With that, the market share also increase. Market share, they think on this. With this approach, the market share also increase. And see, they think of their shareholders. Whose wealth? They are creating wealth now. They are creating wealth of what? They are creating wealth for the shareholder. They are creating wealth for the public also, society also. So that is, they think about the shareholder and they only think on the profit approach. So obviously, this method is more valuable. We have to, and you cannot leave the profit also. We have to make a balanced approach. But first priority is your wealth, and then with that you are going to earn profit also. Yes or not? Yes, definitely you are going to earn. So this is the your some method where you are going to see in the financing decision. So see, so now let's move to the PPT and now see how many much time we have. 8:37. We have time, so let's move. So we have seen what is finance, we have seen what is financial management, and we have seen the three different type of decision like financing decision, investing decision, and dividend distribution. And with this, you see this one with PPT. Now move to the PPT. See financial management. So you have seen the financial decision. You're where you got the money, collecting money, that is capital, collecting capital. This related to the choices of resource, choices of sources of fund, determine capital structure, that is debt versus equity, affect cost of capital and financial risk. With example, you see a company requires 5 lakh, it may raise fund by issuing equity share, taking a loan at 10% interest. So choosing the appropriate mix is a financial decision. What? Easy peasy. We have understand this in a very detailed way. Now see the investing decision. What is invested? You have collected the money. Now you are going to invest that, and you will see the IRR. Your how much return is going to see. With that, you are going to invest. Otherwise, if the project will be not valuable, you are not going to invest in that project. So that is your investment decision. This relates to the selection of asset in which the fund will be invested, known as capital budgeting decision, affects long-term profitability and risk. So say with example, a firm has 10 lakh to invest. It must choose between two projects. Project A, whose IRR is internal rate of return is 12%, and project B, whose internal rate of return is 15%. So you will choose which one? 12 or 15? You will choose 15. Why? Return is higher. You have to compensate you have to see with what? You have to see with cost of capital. Because this is, यही तो लिए थे ना कैपिटल, अब यही तो रिटर्न देखोगे ना with whom investing से कि 10% आ रहा cost I have to pay and I am getting 15%. So I will choose this one, not this. So decision to select a project B is investing decision. Okay, project B is you are going to choose. See the function of financial management. What is so this is the third function, that is your dividend decision. This relates to the distribution of profit. How much profit to distribute and how much to retain for the future growth. वही था, distribute कितना करोगे dividend या फिर interest, and future growth के लिए कितना रखने वाला हो, that is retained earning your. So profit earned 1 lakh, dividend paid 40,000, and retained earning is 60,000. This is the allocation of your dividend decision. Easy peasy. Yes, ma'am. So see the objective of the firm. I have told you now there is a two objective. No, there is a many objective. As per the time flow, the objective got changes. The traditional was profit. Now the wealth maximization. So it's depend on the time. So profit maximization. It's aim at maximizing short-term profit. Limitation. What is the limitation of this? Ignore risk. We forget. Where the profit comes with a risk. Yes or no? No gain. No risk, no gain. We have heard in the comments. Yes or no, commerce student? So ignore time value of money. We ignore here time value of money, and we consider here time value of money in the wealth maximization. We here see the cash flow. We see here not suitable for long term decision making. Why? Because in the long term we need what? Certainty. In the short term we are uncertain, and uncertainty is involved with a risk. Yes or no? So wealth maximization, it's aim at maximizing the market value of share, consider the risk and return, consider time value of money, focus on long-term growth, ग्रोथ के बारे में सोचता है, किसके बारे में सोचता है, शेयर होल्डर्स के बारे में सोचता है, पब्लिक के बारे में सोचता है. So that is a very good thing. So conclusion is what? Wealth maximization is considered a superior objective. Now see what is this? Role of Chief Financial Officer. Who is Chief Financial Officer? So see, there is a one organization. किसका organization है ये? Whose organization this one? हमारी नीतू student का है. Whose factory is what? Chocolate. So सबसे top पर कौन बैठता है? Who are going to sit on the top? See, board of directors is going to sit on the top. उसके बाद कौन बैठता है? Who is in the next? That is your CEO. You can see here also this one. And then your CFO, that is Chief Financial Officer. And what is the work of this Chief Financial Officer? See, क्या करते हैं ये? The Chief Financial Officer is responsible for managing the financial activity of the firm. And what are the financial activities? See, the financial planning, fundraising, investment decision, risk management, and financial reporting. For example, see, the CFO decides whether the company should issue share or raise a loan. They are basically taking this decision. Decision on what? Financing decision. कहाँ से money आने वाला? And you have seen the different approaches from where the company is going to collect the money, like equity share, preference share, then debenture, angel financing, venture capital. From where they are going to get the money, so that the cost of capital will be lower and the value of the firm will be the higher. So this is a simple approach you have learned. And the financial environment. What is the financial environment? Environment जहाँ हम लोग रहते हैं, आसपास हमारे क्या है? देखो आसपास क्या है? So see, I have a laptop in front of me. So देखो financial के भी कुछ environment होता है. What is the environment? External factor influencing the financial decision. It includes financial market. क्या include करता है? Financial market, financial institutions, and the regulatory framework. And what is the financial market? Tell me what is financial market. So basically, financial market where there is a flow of capital happen, a flow of money happen, a flow of finance happen, where from the borrower to the sender. So that is the financial market do. So you can see there is a two market, that is your capital market and the money market. And you know that money market is what? Basically short term market, where the money is going to invest or they collect money for a year. And capital market is greater than 1 year. So in the money market, you collect money from treasury bill, and in the capital market, we go for share, debenture, mutual funds. Got it? Easy. These are the financial market which affect what? Your financial environment. And the financial institution, like the institution do what? Financial institution like banks, NBFC, they do what generally? They do what? Tell me. They do what? They collect money. From where? From us. Obviously, they collect money and then save it and then they invest somewhere and then going to return something. So basically, they keep your money. They provide credit also. And you see the banks. There is a bank who going to collect the money, who going to lend the money also. But NBFC is what? NBFC is a non-banking financial institution or corporation. They are corporation. Corporation, non-bank NBFCs. Yes. So they are going to do what? They generally lend the money. They generally what do? See here. Yes, they generally bank is what? बैंक बेसिकली क्या करता है? बैंक कलेक्ट मनी. Bank generally what? They we deposit the money, and with that deposit, they take our money, they keep our money, they also lend the money also. And on the other hand, कौन है हमारे पास? They do what? They don't take a deposit. यही तो गड़बड़ हो रहा है. It's easy. They generally don't take a deposit. They do what? They only lend. They provide a loan, okay, to the needy people, okay, and they provide also some other services. But basically, they don't take a deposit from the public. Their main purpose is providing a loan to the customer so that they can fulfill their demand. So that is the financial institution. They do what? Institution like bank, NBFC mobilize saving. They generate saving and provide loan or credit facility to the business. So these are what? Intermediaries that provide a financial services. They are providing services, yes or no? And which type of services? Financial services. And the financial market, as I told you, money flow karta hai from borrower to the lender. So they both are happy. And the regulatory framework is what? Regulatory framework is some rules and regulations who are going to regulate, like government is going to regulate, RBI having some policy of repo rate on the banks. So this is the process through which they are going to control the inflation, deflation. So these are the sources which create your financial environment. And the government is what? Government is also regulating some framework like tax, TDS on the cryptocurrency. So these are the financial environment. Example, see, if interest rate increases, borrowing become costly, affecting financial decision. Got it? Easy. क्या था? Interest rate increases. Because अब interest rate कितना है? If you are taking a loan, it was 8%. And if interest rate is going to be 12%, then तुम क्या loan लोगे? You are going to take a loan. No, you're not going to take a loan. So that's this is showing is what your loan taking will become lower. So affecting the financial decision. कहाँ से लेने वाले हो? Collect कहाँ से करोगे fine? So these are the factors which create or which affect your financial decision also. That is a financial environment. Now see what is time value of money. So what is time value of money? So the sum of money has different value at different point of time. Money का different value पे different time होता है. How? There's a basically three reasons of that. See, earning capacity of money. Earning capacity. क्या capacity है earning का? Money has the ability to earn return when invested. Example, see, present money can be invested to generate interest or profit over time. Yes, that will give you interest. How? See, if 1,000 is invested in a bank, you are going to get interest of 10% in a year. Then you are going to get a money. So money having what? Some earning capacity. So that's the time value of money. So inflation is what? That is, I will tell you na, 100 rupees. Now you are buying a coconut water of 2 coconut water. Why I'm writing buy one get one? It's like see, it's like 2 coconut water. Coconut water getting, and in 2027 with 100 rupees you are going to get only 1 coconut water. So that is the time value of money. Your money is price is going to be higher. So at that time, your capacity or your purchasing power is going to decrease. So value of money decreases due to the rise of price level. So example, you can see this, what I have explained you. You can see my example also. So risk and uncertainty. Future is uncertain. Here the future receipts are risky. Obviously, we need what? Present में. Present. We always prefer present cash. Yes or no? अभी दे दो पैसा. In future, कल किसने देखा है? कल रहे हम. हाँ रहेंगे हम लोग. Yes or no? So that is the time value of money. Easy peasy. Yes. Now see the compounding technique and the discounting technique. What is compounding? See, here you can understand also the future value of money. Compounding is future, something adding. So आज जो है future में what you are going to get, that is your compounding. And in the future is something now present you are getting, that is your discounting. Got? So this is your the future. So future is your compounding. And discounting is your present value of money. So see, there is some formula for that. You can see here also what I am explaining you here. Future value of money. That is your what? You are going to get a future value of money. That is your present value plus 1 plus your rate of interest and number of year. And on the other hand, how you are going to get a present value of money? See, अगर ये वाला निकालना है, you want to keep here, just keep here. Present value of money, and you can write the future value divided by 1 plus rate of interest, and upon there is a number. Got? So this is the formula. You will get the money. You want to see the example? चलो दिखाते हैं तुम्हें example के through. So see, so 1000 invested at 10% rate. So investment is what? 1000 rupees. What is the rate of interest? 10%. And what is the number of year? 2 years. So now you are going to get future value of money. आज का पैसा 1000. You are going to invest. And now you are going to get after a 2 year. कितना पैसा मिलने वाला है तुम्हें? So see, कितना पैसा मिलने वाला है तुम्हें? So present value 1 plus rate of interest and then your number of year. So your present value is what? Present का value कितना है? 1000 rupees and 1 plus rate of interest is 10% and the number of year is 2. So 1000 rupees 1 plus 10 you can write here in percentage because 10% is there. So 1 plus 1% or you can write like 1 plus 10 by 100 upon 2 and then 1000. You can cut. So 1 by 10 to 10 square. You can do with your own also. So this one is 11 by 10 into 11 by 10. Ting, 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 ting. So 11 into 11 कितना होता है? 121 मैम. और ये हो गया 0. So you are going to, in the future value of your money, which is now cost is 1000 rupees. कितना हुआ? Become 1210. That is your time value of money. So that is your future value of money. Okay. And that is your compounding method. Or on the other hand, you can see this one also. Same approach. With that, you can see. Let me see the time. We have time. So see, you can see what is the formula? Present value. Example see, same example you can do at your home also. 1210 is your future value of money, and you want to know the present value of money. Timing is 2 years, same thing. So your future value is 1210, and your number of year is 2 year, and your what rate of interest is 10%. Simple. And what is the formula? Same formula. With one formula, just learn one, you will get the second one automatically. So present value is what? Future value upon 1 1 plus r. Yes, this one is n. So just write. So just put your value inside. Your future value is what? 1210. 1 plus rate of interest is 10 by 100. That is your 10%. And number of year is 2. So solve it. 1210. Simple, we can watch from there, but don't watch from there. Cut. So you are going to get 10. 10 plus 1. 1210. 11 by 10. चलो डबल कर दें. 1210. 1210. 100. So you can cut simply by this, but चलो normal देखो पूरा एकदम. 100 by 1210. Cutting. Why we are getting 100 rupees? 1210. 1 plus 10 by 100. Yes. 10. 11 by 10. 11 by 10. 11 by 10. 1210. 1210. Yes, 1210. Something is missing. 1210. 100. 1210. Cutting. 100. I'm getting 100 rupees. Why did somewhere? No. We can do. Let's do. See the formula, just present value of money equals to future value upon 1 plus r by n. Simple. Yes. Future value is what? 1210. Simple. Yes. 1 plus rate of interest is what? 10%. Simple. Easy. Yes, ma'am. 1210. And then I cutted this one. So we can cut. Why not? We cannot cut. Cut it. 10. 10 plus 1 square. 1210. 11 by 10 square. 10 into 11 by 10. I got. It's easy, yaar. Why we did that? 1210. See, simple. We did one error. 121. 11 into 11 is what? 121, not 1210. So why you have written 0 here? And simple is 100 rupees here. So 1210 into 100 divided by 121. Cutting. You got the 1000 rupees. ये गड़बड़ हो गया. It's okay. So just right here is your 1000 rupees is your present value of money. Easy peasy. बहुत easy, ma'am. So what is annuity and what is perpetuity? So annuity is what? See. So annuity is what? Annuity is your same amount of money you are going to invest into the same interval of time. Yes. See, annuity is a series of equal payment made at a regular interval. When you are paying equal amount made at a regular interval. So interval will be regular. Okay. See, with example, you are receiving 5,000 rupees annually for the 3 year. हर साल तुम्हें 3 year के लिए मिल रहा. So you can see the same amount of money you are going in a regular way. So that is your annuity. And what is perpetuity? A perpetuity is annuity. Your annuity is a perpetuity. Okay. That continuous indefinitely. मतलब जो चलता रहे. नाम में लिखा है perpetuity. चलता रहे. So see example. 1000 received every year forever. हमेशा के लिए. Not only for 3 years. So that is your perpetuity. Now see risk and return relationship. So we have seen the three decisions: financing, investing, and then dividend decision. So when you are investing, so you are going to get some return, and you compared with what? KO, that is your cost of capital. So you have compared that. At that time, you will see your risk and return factor. See, the risk and return relationship signify that the expected return on your investment is directly related to the risk associated with it. Investors are risk averse. They require additional return, like a risk premium for taking additional risk. They need what? Risk premium चाहिए भैया. क्यों? We need because we are getting additional risk. That's why we need a when there is a risk, when there is a gain. Simple. There exists a direct relationship between the risk and return. There is a same relationship going up, down, down. Same relationship. Okay. So higher risk, higher expected rate of return. Lower risk, lower rate of return. Government bond. Example, you see government bond where low risk and you will get the low rate of return. And the equity share, why? It's a high risk, yes or no? So you are going to get a high return also. That's why it's very costly also. Not only that, why? That's why. No, equity share is your owner capital, owner fund. So obviously that will be the not cheapest, that will be the costly. So see the nature of relationship. The relationship is positive, direct. There is no guarantee, but an exception. What is the exception? See, increase in risk. अगर risk बढ़ता है तो भैया तुम्हारा return is also going to be high. When your risk will less, return will be less. Same relationship with them. So concept of risk premium. Risk premium is additional return over risk-free rate of return. So you know that na what? When you are going to get a risk, देखो क्या बोला? Risk premium is the additional return over a risk-free of rate. एक होता है risk-free rate. मतलब ये तो basically where you will get the risk-free rate of return. मतलब you know that इतना return I'm going to get. So that is your risk-free rate of return. Suppose you are applying into the government bond. So you know that fixed amount of return I'm going to get. So that is your risk-free rate of return. And with over that, if you are going to take a risk, so that is your that is what. If you are going to take that extra risk at that time, you are going to get that extra premium also. Simple. So formula is what? Expected return, risk-free rate. Risk-free expected return is what? Risk-free rate plus risk premium. That is your RF plus. Let's go risk premium. Select go premium. Obviously, यहाँ पे something different decorate होगा. But I'm just writing risk premium like that. Okay. So see with example, you can see that risk premium. So this is your see there is a total risk in the market. So suppose this is the formula of your CAPM model. That is your capital asset pricing model. This is the one model. You will see here what you will see. You will see the risk and return. How much you will see the risk factor here. So that is a very valuable method of calculating your risk and return. So here you will see there is a risk free of return. इतना तो मिलेगा ही मिलेगा risk free rate of return. With that you will see the beta. Beta is what? Your risk factor. Beta is your risk factor. So you will see there is a two type of risk. One is systematic risk, and on the another hand, you will see the unsystematic risk. Systematic risk is what? That is a compulsory, not diversifiable. Milega hi milega. You have to face it. And on the other hand, unsystematic risk, that is a diversifiable. You can diversify that. You can take off that risk. So see, systematic risk affect the entire market. सबको face करना पड़ेगा. Cannot be eliminated. It's a everybody is going to face. That is your inflation. That is the interest rate changes. The economic recession. And what is the unsystematic risk? Diversifiable. You can diversify your portfolio, and with that you can compensate. You can trade off your risk. See, specific to the company industry can be reduced through diversification. Example: strike in a company, management failure. With example, you got it. Easy. Yes. So here you can see RF is your risk-free. RF is your risk-free rate of return. And this you let's do little up it. No, first see no, first see the formula. Then I will tell you the example. So this is the formula. So see, this is your formula. What is your formula? I'm erasing it, writing again. So see, this is the formula, that is RI. What is R? Required rate of return. And RF, that is risk-free rate of return plus beta. And that RM, that is your total market rate of return. Total market se kitna return aa raha hai. And RF, you know that risk-free rate of return. You can see all this terminology here also. So this is your total required rate of return. कि कितना आने वाला है तुम्हारा return. Okay. And this one is your risk-free rate of return. And with that, suppose your risk-free rate, government bond may you have invested, there is a no risk. So you are going to get the same rate of return. Yes or no? So suppose, see, risk-free rate of return, government bond is 6%. You can write here 6%. Fixed. I'm going to, it's a risk. 6% to milega hi milega. And then you are going to see the beta. That is your systematic or unsystematic risk. You will see here. And with that, you are facing, you are getting this risk. That's why you are going to get the return. Got easy. You are facing that risk. That's why you're going to face the risk premium also. See. So you have invested into the share market also. 14% return is 14% investment in share. Investment in share is 14%. Okay. And the risk premium is 14% minus 6%. That is your, this one is a risk free rate of return. Suppose 14% is your total market return, and risk free rate of return is compulsory, that is your 6%. Same. And beta is something in the point, you can see like a 5%, you will see like 0.5. I can take any value, I'm just taking randomly. Okay. And then 6 minus karo kitna hoga? 8. Yes ma'am. And you will get some amount, that is your required rate of return. That is your required rate of return. So basically this is a capital asset pricing model, CAPM बोलते हैं उसको. With that you will see what? Risk and return. So this 8% is compensated for uncertainty. This 8% is compensated for uncertainty. And what is that? That uncertainty? That uncertainty is your risk. So you got to know that, yes or no? Easy? Simple. When you are facing a risk, you are going to get some extra premium. Why? Because you have faced the risk. So you have to do what? Take the risk and take the gain. I'm not telling you that. Okay. I'm just telling you a normal thing. You're getting some, getting into the risk. You're getting into some premium. You can face loss also. But this is a normal approach, general approach, which CAPM model provide you, where you can see what is the risk and what is the return. You can compare it. And this is the best model of comparing that. Now see the risk return trade-off. Investor must balance between the risk and return. Higher the return, higher the uncertainty. Yes, obviously. Higher return, higher uncertainty. Lower risk, stable but lower return. See, for example, you have a three option. You have invested in government bond, corporate bond, and the equity share. The government bond, you know that the risk will be low here. So the expected return is also low. And the corporate bond, you will see the corporate bond where the risk is medium. So your return is little bit higher, like 10%. Okay. And on the equity share, the return is very high. Why? Because there is a very high risk. So that's why return is also very high. The choice depend on the risk tolerance and the investment objective. You can read this by own also. Risk aversion behavior, like see assumption. Investors are risk averse, meaning prefers certainty over uncertainty. What we think, we need what? We need certainty. We need certainty. We don't. I don't need extra money. We need. We need what? We are that type of people. We need. We want a less risk also, and we need more premium also. We think like that also. So investor. So prefer certainty. We prefer certainty over uncertainty. Prefer low risk for same return, except higher risk only if compensated. Example, say if you have a two option, option A is 10,000, your guaranteed return, and option B 10,000, 1,000 with risk. So what you are going to choose? Investor chooses A unless B offer higher return. So you are going to go for guaranteed one, not for the risky. We can switch to the risky if the return will be higher, obviously, like 1200. So measurement of risk is what? Risk is often measured using variable. So you can measure risk with different things like your standard deviation, higher variability. With that, you can see. So real market interpretation. See, so there's a different investment like your treasury bill, bank deposit, mutual fund, equity share. You can compare it. In the treasury bill, the risk is very low and the return is very fixed. Bank deposit, low, stable return. Mutual fund, medium type. Return is variable. Equity, very high, highly volatile market. And the cryptocurrency is maha volatile market. So risk doesn't ensure your return. It only increases the probability of your higher return. Example, share may give you 20% or negative minus 10%. So it's a probability of your, it's a generally a probability. You can approach it, you can forecast it, you can think on it. So see practical implication in the financial management. Manager must select project with optimal risk return balance. Optimal risk return balance, avoid excessive risk, maximize the shareholder wealth. Conclusion, investors expect to be adequately compensated for bearing risk, definitely, and such compensation is in the form of higher expected return. Cool. Risk and return are positively related, yes. Up, down, down. High the risk, high the return. Lower the risk, lower the return. And even high the expected return through not guaranteed. Though not guaranteed. So this is your risk and return approach. And here you can see something. It's easy peasy terminology. You can read this here also. Like what is the risk concept? Risk doesn't ensure your return. It only increases possibility of gain and loss. Expected return is what? Average return expected from the. It's easy. Expected what? What you are expecting return. Volatility, variability, कितना changes हो सकता है, like higher, lower, something you don't know, uncertain, everything is uncertain. Risk return trade off, you are trading off between what? How much risk, how much return. So you are going to trading off, you are watching. Oh, you need what? Trade off, balance approach you need. So market condition is what? Environment condition, overall market situation, company fundamental, financial strength, performance of a company. Diversification is what? How much your portfolio is diversified. You have investment in a different way. Like you have investment in cryptocurrency, mutual fund, like your bank, FD, whatever. That is your diversification of your investment. Time horizon, that is your investment period. Liquidity, ease of buying and selling. And systematic risk, which is applicable to the whole. Everyone is going to bear it. And unsystematic, it's a reduced through diversification. And risk premium is what? When you are facing risk, you will get the premium. Return calculated using CAPM model. We have done this. So this is the teeny tiny concept we have learned. And here you can see also, this is the small terminology you have seen in the bull market. And what is bear market? In the bull market, everything is high, high, high. Bear market, everything is low, low, low. Let's see. So market is rising, is a bull market, and the market is falling, is your bear market. Investor sentiment is what? Optimistic, positive. Bear market now, the cryptocurrency is bear market now. So pessimistic, it's a negative. Stock prices, like prices increases continuously, prices decreases continuously. The demand for share is high here the low. It's just a normal approach you can see from here. Economic conditions, strong economic growth, higher confidence, weak economy, slow slow down, uncertainty will be there. Investor behavior is what? More buying. Here they do more selling. Profit opportunity easy to earn, capital gain difficult, risk of losses. And the example is boom period, expansion phase, and here the recession and the crisis period. So this is the small teeny tiny concept of bull market and bear market. And with this we are going to end. We have completed. So there is a no right time, just time and what you do with it. So with that note, I'm ending my lecture.
Thank you
Thank
so much, ma'am. It's really great session, and I don't think that any undergraduate students have any doubt about all these basic concepts related to financial management. Thank you
you.
so much, ma'am, for bearing time with us for the students, and thank you so
Mhm.
much, ma'am. I hope we will get your lectures in the upcoming sessions also. Thank you so much, ma'am.
Cool. Thank you.
So, with this, we are concluding today's session.